While most investors were distracted by rate cuts, equity rallies, and election headlines, something far more structural shifted in the background. It didn't happen on a trading floor. It didn't show up in a CPI print. It didn't trend on social media. But it is already changing the physical flow of one of the world's most strategically important commodities. The silver market is not crashing. It is being drained. That is the core event. Physical silver inventories are shrinking at a pace that paper markets were never designed to absorb, and the buyers doing the draining are not speculators. They are industrial systems, sovereign supply chains, and manufacturers who cannot function without it. Most people miss this because they look at the price chart first. They see silver at 23, 24, 25 an ounce and assume nothing is wrong. In modern markets, price is no longer a clean signal of scarcity. It is a negotiated output between leveraged futures contracts, ETF share creation, market maker hedging, and margin-based positioning. What matters now is not just how much silver exists, but where it is, who controls it, and whether it can be delivered on time. The forcing mechanism is industrial demand colliding with inventory concentration. Over 55% of global silver demand is now industrial. Solar panels alone consume roughly 180 million ounces per year, up from under 90 million a decade ago. Electric vehicles use between 25 and 50 grams of silver each. Data centers, AI hardware, 5G infrastructure, medical devices, and defense systems all rely on silver's conductivity and antimicrobial properties. This is not discretionary demand. A smartphone can be delayed. A solar deployment contract cannot. At the same time, above-ground inventories have become thinner and more centralized. Exchange-tracked stockpiles in major hubs, London, New York, Shanghai, represent only a few months of industrial consumption. In some years since 2020, the market has run physical deficits estimated in the 100-200 million ounce range. Those deficits are not theoretical. They are filled by drawing down existing bars. Here's why this matters now. Industrial buyers do not trade silver. They procure it. When procurement windows tighten, they stop caring about spot price and start caring about certainty. They lock supply forward. They bypass retail channels. They negotiate directly with refiners and miners. They remove metal from the pool that paper markets quietly assume is available. This is the part most people miss. Futures markets are built on the idea that most contracts will never settle in metal. They are liquidity engines, not delivery engines. But when a rising share of demand insists on physical certainty, the structure bends. The system can tolerate speculation. It struggles with procurement. What's at stake is not a single commodity price. Silver sits inside the energy transition, the electrification cycle, and the digital infrastructure build-out. A persistent physical squeeze transmits into project delays, cost overruns, and policy friction. It becomes inflationary in places that monetary policy cannot touch. A central bank can raise rates. It cannot fabricate conductive metal. Now here's where it breaks. Price can stay calm while the system underneath tightens. Inventory drawdowns do not ring bells. They show up in shipping delays, longer lead times, higher premia for good delivery bars, and a widening gap between what screens say and what factories pay. This analysis is educational only and not financial advice. Markets involve risk, including loss of capital. The purpose here is to explain structure and incentives, not to recommend any action. Always consult qualified professionals before making financial decisions. To understand why silver can be drained without the price screaming higher, you have to separate two markets that most people mentally collapse into one: the paper silver market and the physical silver market. They are linked, but they are not the same machine. The paper market is dominated by futures contracts, options, swaps, and ETF share creation. On exchanges like COMEX and in London's OTC market, silver trades in standardized units, most commonly 5,000-ounce futures contracts. At any given moment, the notional open interest in these contracts often represents 5 to 10 times more silver than actually exists in deliverable form. This is not fraud. It is design. The system assumes that nearly all participants will roll, close, or cash settle. Only a tiny fraction, often under 2%, ever request metal. That assumption holds as long as silver is treated primarily as a financial asset. The physical market operates on a completely different logic. Manufacturers do not care about mark-to-market P&L. They care about tonnage, purity, form factor, and timing. A solar panel producer does not hedge price exposure abstractly. It hedges input continuity. If a plant consumes 400,000 ounces per month and has a 90-day buffer, its risk is not volatility. It is interruption. Here is where the friction appears. When an industrial buyer secures long-term supply, that silver exits the floating inventory pool. It is no longer part of the metal that can be mobilized by market makers to settle deliveries, support ETF creations, or smooth futures expiry. The paper market still references that metal in theory. The physical system no longer has it. Consider a simplified example. Assume a regional exchange vault holds 120 million ounces of registered and eligible silver. Monthly industrial draw is 10 million ounces. Mining and recycling feed 8 million ounces per month into that region. On paper, this looks manageable. The futures curve clears at 24.50. Spreads are narrow, volatility is low, but physically, the system is bleeding 2 million ounces per month. At that rate, the vault loses 24 million ounces per year, 20% of its starting stock. The paper market does not see this until delivery stress appears. Price can remain calm because most participants are trading claims, not bars. But procurement desks are watching lead times extend from 2 weeks to 6 weeks. Fabricators are paying $1.50 to $3.00 per ounce over spot for guaranteed form. Refiners begin prioritizing contract clients. Now here's the structural twist. Futures exchanges do not require that every open contract be backed by metal. They require that deliveries demanded be satisfied. As long as only a small share of longs stand for delivery, leverage can remain high. The problem arises when industrial demand changes the behavior of marginal participants. When manufacturers hedge forward, they often convert paper exposure into physical inventory. When sovereign entities stockpile, they remove metal from commercial circulation entirely. When refiners lock output to strategic buyers, less material is left for spot settlement. Each of these actions reduces the free float. Think of free float in silver the way equity traders think of float in a stock. A company may have 1 billion shares outstanding, but if 700 million are held by long-term insiders, only 300 million actually trade. Price becomes more sensitive. Borrowing costs rise. Volatility increases. Silver is undergoing the same process, quietly. Backwardation is one signal. When near-term contracts trade above longer-dated ones, it indicates urgency for immediate delivery. Elevated lease rates are another. Rising premia on coins, bars, and industrial forms are a third. None of these need a headline. This is the part most people miss. The paper market can clear at equilibrium even while the physical system becomes brittle. The chart looks stable. The supply chain does not. The silver market was built for financial liquidity. It is now being asked to provide industrial continuity. Those are different jobs. One can operate on leverage, the other cannot. When a system optimized for rolling contracts is forced to serve delivery at scale, it does not break dramatically at first. It tightens, it rations, it reprices off-screen, and by the time the price finally reacts, the metal is already gone. Every structural market shift eventually reveals who has optionality and who does not. In the silver market, that line is now clear. Some participants can walk away from a trade, others cannot walk away from delivery. The most constrained actors are industrial consumers. A solar manufacturer that has signed a multi-gigawatt installation contract does not have the luxury of waiting for price. A data center builder cannot substitute aluminum for silver in high-density connectors without redesigning entire systems. An EV producer cannot ship vehicles missing power control modules. These firms are structurally long silver in the real economy. Their exposure is not a position. It is embedded in revenue. Their choice is binary, either secure metal or stop producing. That constraint changes behavior. Instead of sourcing month to month from distributors, they push upstream. They negotiate directly with refiners. They prepay. They lock multi-year offtake agreements. They request specific bar formats and fabrication schedules. Every ounce they secure this way bypasses the spot ecosystem. On the other side of the structure sit market makers, bullion banks, and futures intermediaries. Their business model assumes turnover, not hoarding. They warehouse metal temporarily to facilitate trades, ETF creations, and contract settlements. They hedge exposure dynamically using futures curves and lease markets. They rely on the fact that most longs will not ask for bars. But when physical demand rises and free float shrinks, that assumption becomes fragile. A bullion bank that is short 50 million ounces synthetically across futures and swaps can manage that risk if it knows only 1% of longs will ever request delivery. If that rises to 3% or 5%, the math changes. Suddenly, 1.5 to 2.5 million ounces must be sourced on demand. If vault stocks are falling and refiners are pre-allocated, sourcing becomes expensive. Lease rates spike. Borrowing metal becomes competitive. Hedging costs rise. This is where trap dynamics emerge. Short sellers in silver, whether directional traders or structural hedgers, are not wrong in theory. The market has operated this way for decades, but they are vulnerable to regime change. When the marginal buyer shifts from speculator to manufacturer, price sensitivity flips. The buyer does not care if silver is $24 or $32 if downtime costs $5 million per day. Either paper shorts roll indefinitely or physical supply tightens. One of those must give. There is also a geopolitical layer. Governments increasingly treat critical materials as strategic inputs. China controls roughly 60% of global silver refining capacity. Several nations have begun to classify photovoltaic components, grid infrastructure, and semiconductors as security assets. In such an environment, sovereign stockpiling is rational. When a state buyer removes 20 or 30 million ounces from the market, it does not show up in COT reports. It shows up in shipping manifests and customs data months later. Historically, we have seen this pattern before, though never at today's scale. In 1979-1980, the Hunt brothers attempted to corner silver through futures and physical accumulation. The price exploded from under $6 to nearly $50 per ounce. But that episode was driven by speculative leverage. When rules changed and margin requirements rose, the structure collapsed. Today's dynamic is inverted. The accumulation is not speculative. It is operational. Solar installations in 2024 alone are estimated to require over 160 million ounces. Global mine supply is roughly 850 million ounces per year. That means one industry absorbs nearly 20% of annual output. This is similar to what happened in palladium between 2016 and 2021. Auto catalyst demand collided with constrained supply. Inventory buffers vanished. Lease rates surged. The price quadrupled. The squeeze did not begin with a headline. It began with fabricators paying whatever was required. The difference is that silver is far more embedded across sectors. There is no single choke point. There are dozens. The trap is simple. Industrial users must buy. Refiners must allocate. Bullion banks must deliver. Futures markets must clear. Either metal flows toward production or the financial structure absorbs the strain. And financial structures are designed to shed strain by repricing. The silver market looks calm because most people still analyze it like a trading instrument. But silver is not just traded, it is consumed. Once it enters a circuit board, a photovoltaic cell, or a medical coating, it is effectively removed from circulation. Recycling exists, but it is slow, fragmented, and price insensitive in the short run. So the correct lens is not price discovery. It is inventory math. Start with broad ranges, clearly labeled. Global mine production in recent years has averaged roughly 850 million ounces per year. Recycling contributes another 200 million ounces. That places total annual supply in a scenario range of 1,050 million ounces. Now look at demand. Industrial use has grown steadily and now sits in a range of 600 million ounces per year, depending on solar installation pace and electronic cycles. Jewelry and silverware consume another 200 million ounces. Investment demand, bars, coins, ETFs, varies widely, swinging between 50 and 250 million ounces annually, even using conservative assumptions. Scenario A, balanced year, supply, 1,000 million Oz demand, 520 industrial plus, 180 jewelry, plus 150 investment was 850 million Oz, result was 150 million Oz, surplus scenario B, high industrial year, supply, 980 million Oz, demand was 580 industrial plus 190 jewelry, plus 180 investment, or 950 million Oz, result, or plus 30 million Oz surplus. Scenario C, tight year, supply, in our 960 million Oz, demand, your 600 industrial plus 200 jewelry, plus 220 investment, or 1,020 million Oz, result, in our 60 million Oz deficit. These are not extreme assumptions. They are well within historical ranges. What matters is not a single year. It is persistence. When scenario C repeats for 2 or 3 consecutive years, 180 million ounces must come from inventories. Those inventories are not evenly distributed. They are concentrated in exchange vaults, sovereign reserves, and ETF custodians. Publicly visible exchange stocks across major hubs often total between 250 and 350 million ounces in deliverable form. That sounds large until you apply operational reality. Industrial systems do not function at zero buffer. A solar manufacturer cannot operate with 2 weeks of metal. Utilities cannot deploy grid infrastructure on a just-in-time model. Procurement desks typically aim for 120 days of secured supply. If global industrial demand is 550 million ounces annually, that is roughly 1.5 million ounces per day. A 90-day buffer implies 135 million ounces locked in pipelines at any given time. That metal is not available to exchanges. Now here's where normal expectations fail. Paper markets assume that visible inventory represents a usable backstop. But in practice, a portion is earmarked for specific clients. A portion is in transit. A portion is in non-standard form. A portion is held as strategic reserve and will not move at any price. So the effective free float may be a fraction of what headlines imply. Imagine visible stocks of 300 million ounces. If 120 million are embedded in industrial buffers and another 80 million are tied to sovereign or long-term holders, only 100 million ounces remain flexible. At a 60 million ounce annual deficit, that free float shrinks by more than half in a single year. The futures market, however, may represent claims on 2 to 3 billion ounces through open interest and derivatives. That leverage is sustainable only if delivery requests remain tiny. This is why price alone is a misleading indicator. A futures curve can clear at $24 while physical lead times extend from 2 weeks to 8 weeks. ETF shares can be created using leased metal even as refiners refuse spot orders. When a physical market tightens inside a paper-dominated structure, the reaction rarely arrives as a smooth price trend. It arrives as discontinuity. Spreads move before spot. Volatility rises before headlines. Liquidity thins before anyone agrees there is a problem. This is because the silver market does not reprice through a single channel. It transmits stress through multiple layers at once: futures curves, lease markets, ETF mechanics, dealer inventories, and margin systems. Each layer responds for its own internal reasons, but together they form feedback loops. The first transmission point is usually the near-dated futures curve. As physical buyers demand immediate metal, the front months begin to trade firmer than deferred contracts. Backwardation emerges. A 1 or 2 cent inversion becomes 5, then 20. For traders, this looks like noise. For fabricators, it signals urgency. Next comes the lease market. Bullion banks borrow silver to facilitate settlement and ETF creation. When free float shrinks, the cost of borrowing rises. Lease rates move from near zero toward 2%, 4%, sometimes higher in tight windows. That cost is embedded into every hedging and arbitrage strategy. Suddenly, being short silver is no longer cheap. Then the ETF mechanism begins to strain. Physically backed ETFs rely on authorized participants to source bars. In normal conditions, metal can be leased, swapped, or pulled from vault networks quickly. In tight conditions, creation's slow. Premiums emerge between ETF share price and net asset value. Retail investors interpret this as irrational. It is structural. The bottleneck is not sentiment. It is metal. As these frictions build, market makers widen spreads. Options implied volatility rises. The cost to hedge increases. Leveraged funds face higher margin requirements. This is where feedback loops activate. A fund that is short silver via futures may be correct on macro thesis, but if backwardation and lease rates raise carry costs, the position bleeds. If volatility spikes, margin requirements rise. If spreads widen, exit becomes expensive. The fund faces a choice: absorb higher cost or reduce exposure. Reduction is not neutral. When a large short covers in a thin market, price jumps. That move triggers stop losses. Options dealers adjust delta hedges. Gamma effects amplify. What began as a logistics problem becomes a price event. Observers often call this a short squeeze. That is partially accurate. But the deeper driver is not positioning. It is inelastic demand. The buyer on the other side is not a trader. It is a manufacturer who must acquire 500,000 ounces by quarter end regardless of price. This is why reactions feel irrational. Price can gap 5% on no news. Volatility can double without a macro trigger. Correlations break, silver rallies while equities fall, or vice versa. The market is not expressing belief. It is clearing constraint. Liquidity vanishes first in the places people least expect. Small bar markets see premia jump from $2 to $6 per ounce. Industrial form factors go allocation only. Dealers quote, subject to availability. Forward contracts include force majeure clauses. On screens, everything still trades. In warehouses, everything slows. This divergence is the hallmark of a physical squeeze inside a financial wrapper. The paper market continues to print prices. The physical market begins to ration. What should observers watch? Not headlines. Plumbing. The front month versus 3-month futures spread. Lease rates and swap points in London. ETF creation redemption volumes relative to price. Delivery notices on major exchanges. Reported vault withdrawals and reclassifications. Industrial premia for 1,000-ounce bars. These indicators move before narratives do. And here is the critical dynamic. Every attempt to stabilize through financial means, higher margins, tighter risk limits, reduced leverage, reduces liquidity. Reduced liquidity increases volatility. Higher volatility raises hedging costs. Higher costs push participants to reduce exposure. That is a positive feedback loop. It does not require panic. It requires structure. Markets are designed to clear price. They are not designed to fabricate inventory. When a commodity transitions from tradable asset to strategic input, the market's primary function changes. It must allocate scarcity, not express opinion. Allocation is never smooth. Structural shifts do not unfold in a single moment. They move through windows, procurement cycles, contract expiries, inventory audits, earnings calls, shipping seasons. The silver market's transition from tradable asset to strategic input will not announce itself. It will express itself through rhythm. Think in layers. Next 24-72 hours. Futures spreads, lease rates, and ETF flows respond first. These are the most sensitive pressure gauges. They react to marginal stress. Next 1 to 4 weeks, delivery behavior changes. Refiners adjust allocation. Dealers modify terms. Industrial buyers lock forward supply. Backwardation, if present, persists rather than reverting. Next 1 to 3 months, inventory reports begin to show trend, not noise. Vault drawdowns become directional. Corporate disclosures reference input cost pressure and supply assurance. The narrative begins to catch up. Within that timeline, 3 broad scenarios frame the path forward. Scenario 1, base case, manage tightness. In the base case, the system absorbs the strain without visible rupture. Industrial demand remains strong but predictable. Deficits persist in the 20-60 million ounce annual range. Inventory drawdowns continue but do not accelerate. Paper markets remain functional, though more volatile. Price drifts higher in uneven steps. Premia stay elevated. Backwardation appears episodically. Volatility increases, but without systemic stress. Confirming indicators. Front-month spreads oscillate but do not remain inverted. Lease rates rise but stay under 2-3%. ETF creations continue, though at slower pace. Vault stocks decline gradually, 1-3% per month. Industrial premia stabilize rather than spike. This is a world where silver becomes tight but not scarce. The market adapts. Risk increases, but the system remains intact. Scenario 2, stress case, structural squeeze. In the stress case, one of 3 triggers accelerates depletion, a surge in solar deployment, a geopolitical stockpiling event, a financial shock that drives investment demand concurrently with industrial demand. Deficits widen to 80-150 million ounces annually. Free float contracts sharply. Delivery becomes competitive. Backwardation persists. Lease rates spike above 4-6%. ETF share price diverges from NAV. Market makers reduce activity. Margin requirements rise. Volatility jumps. Price moves not because of bullish sentiment, but because clearing requires it. Confirming indicators. Sustained backwardation across multiple contract months. Lease rates spiking above historical norms. ETF creation stalling despite inflows. Accelerating vault drawdowns, 5% per month. Industrial buyers publicly referencing allocation or shortage. This is where paper leverage collides with physical constraint. The system reprices availability, not outlook. Scenario 3, relief case, supply response. In the relief case, pressure eases through one of 3 channels. A cyclical slowdown reduces industrial demand. Recycling accelerates meaningfully. New mine supply ramps faster than expected. Deficits narrow, inventories stabilize, spreads normalize, volatility compresses. Confirming indicators. Futures curve returns to contango. Lease rates fall towards 0. Vault stocks flatten or rise. Industrial premia fade. Corporate demand guidance softens. This is not collapse, it is recalibration. But it requires a macro shift or supply response that is neither quick nor cheap. The big picture takeaway is this. Markets are optimized to price expectations. Supply chains are optimized to secure reality. When a commodity becomes structurally embedded in national infrastructure and industrial continuity, those 2 systems diverge. The silver market still looks like a chart. Underneath, it is becoming a logistics network. Price can remain calm while metal disappears. Volatility can erupt without news. Stress can build invisibly until one delivery window fails and the narrative flips. This is not a story about belief. It is a story about obligation. Factories must run. Grids must expand. Systems must be built. And the metal that enables them does not respond to forward guidance. It responds to extraction, refining, and possession. That is why this market is not crashing. It is being drained.